Hello again, and welcome to Clear Skies Retirement with Jay Kirkwood at Secure Financial Management. What is this show? Well, we talk about this thing we call retirement. And what are you doing to get ready? All these years you've been saving in 401ks and IRAs and all these different things you've been doing. And then you get to a point where you got to use that money and you want to make sure it lasts. It's going to go for 20, 25, 30 years. And you go, how do I do that? Well, that is what Jay does every single day and helps people just like you. Jay, how are you doing today?
Really good, Randy. How have you been, buddy?
I'm good, but boy, I tell you what, we got some topsy-turvy stuff happening in markets right now. There's tariffs and there's uncertainty and there's all this different business going on. So we're going to handle some of that today. We're going to handle the headlines and things like that as well. But, when you come to times like this, where the market looks like it's a little uncertain and we're wondering about things like corrections and bear markets and things like that, people get a little uneasy. So I got a story here in front of me that talks about corrections, and the people at Piper Sandler looked at the last 60 years and said, is there anything common here when the market corrects, goes down 10%, which is what we just saw at least with the NASDAQ. And they came up with three things. So I wonder, are we in that territory right now? So number one, sharply rising interest rates. Number two, rising unemployment. And number three, a shocking global incident. So are those things that you see right now? I can see a little bit
familiar,
of it. Yeah,
a little bit about what's going on, right? It does. And there's a couple of things to talk to, I think, with this is, are we experiencing all those things? I mean, I think you could say that, right? Interest rates have gone up significantly in the last few years. It kind of feels that, point to an area on the globe and there's something going on there, right? Whether it's the Middle East, whether it's a Russia situation. And, unemployment's not out of control. It's not bad, but is it trending up from where it was? Yes. I mean, I think you could check all the boxes with that.
Right.
It's also about putting this into perspective too, right? And we've talked about this on other shows, is I have been trying to counsel the people that we get to speak with on the fact like, hey, I know we've had two really good back-to-back years, and that's fantastic. I love it. Our portfolios have done great. It makes my life easier. Of course, it's not always going to be that way, right? And now we're experiencing some of that. I might not be spot on with this statistic, but it's something in this nature. Historically, there's 1 or 2 10% corrections every year at some point, right? It's just we've had a very subdued market, very subdued volatility in the last 24 months or so. And you and I are the same way as everybody else. You have a recency bias, right? Hey, what's happened recently? Well, things have been great. Well, they'll continue to be great. If you understand the markets, you understand investing, that is not going to be the case.
Right. Well, we many times talk about the stock market almost like being at the tables in Las Vegas. And if you're there and you're on a hot streak, you're thinking, let's keep going. And if things start going the other way, you're much more apt to get up and walk away. And then maybe that's kind of where we are right now. And I think that that when we look at those stats that you were talking about there, I think I saw one the other day that says, on average, we have a 10% correction every 300 days. And we've gone more than 300 days. So we are actually due for that. So how do you talk to your clients, and especially somebody brand new who's listening to us right now and says, I'm going to retire in 2 years. It's going to be during this Trump administration, this tariff business, and it looks like markets are going to roil for a while. What does that mean for me? Should I be in more protective mode? Should I pull back from the market? Should I, I'm 65 years old. What should I do about that? How does that conversation unfold?
Yeah, right. So what this person is getting close to, whether they're a year or 2 years or 6 months or whatever it is from retirement, this is what they're starting to realize. We talk about this all the time. They are going from work life to retirement life, and pretty much everything is about to do a 180 in their lives. The time that they've spent at work, 40 plus hours a week, what are we going to do with that time? That's the least of the concerns. People find something to do with the time, right? Whether it's hobbies, whether it's travel, whether it's grandkids. The bigger thing is on the financial side. We're going from a situation of I'm getting a paycheck every 2 weeks or twice a month or however it is that you get paid. I've been accumulating money in my retirement account at work. It's a 401k or a TSP or a 403b or whatever it might be. I've been accumulating and I've been really focused on growth because I've just had my head down, work. And as soon as I put my head up, wow, I'm 12 months from retirement. Things are about to change. And now it's not just about growth with that wealth. Now it's about, do I want some growth? Yeah, I want some growth, but hey, I can't stick my neck out there too much. I don't have as much time as I used to. And I really need a little bit of income and protection. And it becomes more complicated. And that's what's rolling around in the minds of the people in that stage.
Yeah, I'm a golfer, and I have to, stand in front of golf ball and say, is it worth it? Is it worth it to go there, or is it more conservative to go there? And what's going to help my score? And I think that we all kind of have to stand on the tee box of our retirement and go, is it worth it to try to go over that water at 240 yards, or should I lay up and play it conservative? And playing it conservative as you go into retirement is not a bad thing. Do people expect these kind of growth? Does somebody walk into your office and say, I've been getting 10%. Why shouldn't I get 10% in retirement?
So it's the conversation I've had with somebody is I've been getting 15%. So why wouldn't I keep getting 15%? Well, let me point you to the last 5 or 6 weeks. Yeah. And that's why you shouldn't expect 15% anyway, And really, when I think about somebody like that, wouldn't you rather be more conservative on your retirement estimates and then be in a better spot than you expected than the other way around? Because that's what you're doing to yourself, right? You've got to hit 1,000 in your retirement to get that 15%, and it's just not going to happen.
Well, we would love to sit down and talk to you about your retirement. There's going to come a time when you're going to just go, who's helping me with this? Because I am over my skis on this one. I've spent my whole life doing something other than financial, advisory, and because you've been your own CEO of your money all these years, and now there comes a time when you might want to get a little extra help and say, I'm going to go through retirement once. You've been through it 1,000 times with people. Tell me what I'm in for and how I can, protect myself from what's going on. Here's our number and here's our website for Jay Kirkwood and Secure Financial Management. You can find us online at retire210.com. Start right there. If you scroll to the bottom of the page, you're going to see a place where you can put in a little information about yourself. There's even a box there where you can say, this is what I'm most concerned about. We'll know why you're calling. And then we'll get a date on a calendar and talk through it. There's no sales involved here. We're just going to sit there and talk about you and what you want to do and where you come from, what you are doing, and what you want to plan in your retirement years. Then we get down to the real work of it all. You can also call us and bypass all that and just go 210-985-6200. 210-985-6200. All right, so here I got good news, I got bad news, okay? The good news is this. That asteroid that NASA said was going to obliterate us in 2032 is now going to miss. Yay! We do not have the movie Armageddon in our future in real life. That's good. We've dodged the bullet. However, the bad news, when you think about the year 2032, that's just about the time when all this business about Social Security is out there lurking, that the trust fund is going to run out, that they're going to cut back on benefits, all that kind of thing. So I always ask you, Jay, what are people talking about? What are they asking you about? Does this concern people? I know that you're an advocate of maybe taking your Social Security early. The idea of waiting till 70 or taking it at full retirement age, or how should I go about this? Are people really concerned about this cutback? And does that mean that they might take their benefit a little bit early? And is that to their detriment?
Yeah, so that definitely drives some decision making. And, I wouldn't say we're advocates of taking it early, but we want to have the discussion and go through all different options, because what we find out there in the financial planning space is the only discussion is about waiting till 70 to take it. Wait till 70, don't touch it before then. That has its merits. It also has its drawbacks as well. So it's important to have a discussion about, if we wait till then, what does that mean for our investments, and kind of, what sort of longevity should we expect to make it worth the while as well? And so we just have the discussion around, yep, those are pros and cons. These are the pros and cons on the other side. This is the thing, is taking it at 70. Hey, look, man, if you're going to live to 95, then do that, right? If you've got longevity in your family, well, maybe consider that. I got bad news for you. Most of us aren't living till 95, right? It's just not going to happen, right? The other reason we use 62 in our planning, at least our financial planning, is there's a very scientific reason we use that default in our planning. It's because that's just what most people do. they take it at 62, or they take it sometime before their full retirement age. It's the majority of people. And we want to build a plan that is as representative of what's really going to happen than what all these recommendations are, right? Now, do some people go ahead and take it at 62 without looking at anything else because they say, I'm going to get what I can while I can? That does happen. That does happen. I do not believe that should be the reason that you take Social Security early. Could there be other reasons you do it? Absolutely. Should that be the reason you do it? I wouldn't say so. And the reason this is an important discussion is probably everybody listening to this show who is eligible for Social Security or will be shortly is wondering about, should I take it now? Can I rely on it? Will it be there when I need it? And this is the thing, Randy, like unfortunately, there's a lot of people in this country that their retirement is not my 401k and my Roth and my IRA. It's not that. Retirement is whatever Social Security is.
Got it.
Right? So to them, it's vitally important, right? Understandable. We don't think that should be a concern for a few reasons. So I think if you go back to the 90s, we should have ran out by Social Security by like 2015, 2020, something like that, right? And then it gets pushed out and pushed out and pushed out. Fixing Social Security is really not a mathematically difficult thing to do. Politically, it's pretty much suicide.
Right.
That's what the real problem is, right? Is there's a lot of levers that can be pulled to fix Social Security. I've talked to you about this before. My full retirement age is 67. My 3-year-old's full retirement age is also 67.
That's not right.
That probably needs to change, right?
Yeah.
So full retirement age used to be 65, and then I think it was in the 80s, they said, hey, look, we've got to start pushing this out, and it went to 66 in some months, and then it capped at 67. Well, look, I mean, that probably needs to change again, right? That's one, I think, relatively easy lever that can be pulled to extend the trust fund. There's things like, and this is less popular, but right now, Social Security taxes are not necessarily collected on someone's full salary, okay? It's capped at about $170,000, something like that. Might be a little bit more, a little bit less. So if you're one of the few people out there that's fortunate enough to be making above that, maybe it's a very high income earner, it's making $250,000 a year, $300,000-$400,000 a year, a portion or the majority, depending on where they are, of their salary is not getting hit with Social Security taxes, right? I'm not an advocate for that, but is that something that could be done? That's a fairly easy fix. That could be done as well. There's many levers that can be pulled on, which is why we say, hey, look, we have a lot of stuff to worry about. Geopolitical risk, market risk, interest rates, all sorts of things, right? Let's not worry about something that's not necessary to worry about.
Well, what I am encouraged at is at least they're talking about it now. I've been, talking to financial advisors and doing shows like this for over 12 years, and I have never seen Congress at least entertain different ideas like I have in the last year or so. At least they're talking about it. I did hear, I was watching some morning news, and somebody said, with how much we pay out in Social Security, Medicare, Medicaid, and all the other programs that we have, we've become... Our country is an insurance company with an army. It's like, wow, because 90% of what we pay out is in these entitlement programs. So it is certainly something that we're going to have to deal with. And I truly do believe in the 11th hour, when they have to do it and their backs are against the wall, Congress will do it. And
I do as well. Yes.
We'll figure it out. But in the meantime, it's up to us to plan through it. And if you know that you're going to have a 20% decrease in your Social Security in 2032 or 2033, it's time to plan for that. It's time to say, okay, where does that money come from? There's a new gap in my retirement planning. How do I fill it? That's where you can sit down with Jay and talk through it. Give us a call. Give us a look on our website, 210-985-6200. 210-985-6200, a free meeting with Jay, and let's get it all out on the table. You can also use our website, retire210.com, retire210.com, and when you get to the webpage, all the way down to the bottom, there's a place where you can fill in a little information there, and that'll give us what we need to give you a call and get a date on a calendar. Let's do some nuts and bolts. Let's do the math on your retirement. Again, retire210.com. All right, Tony Robbins, he's written a lot of books about money. Money Mastering the Game is one of them. And he is now talking a lot about retirement. And when he talks about 401ks, most of the time he's banging on fees. But he said this recently. He said, the 401k has potentially hurt Americans' chances to gain wealth. He says that there are a lot of things that are good about the 401k, but there are some things that are not. And he said a lot of people are not using the 401k the way they should. Number one, he says you should just simply save to the match and then move on from there. Do your own investing at that point. If you have a Roth 401k, go all in. And if you have both, go all in. But I was wondering about different risk levels and things like that. So I would imagine, Jay, most of the wealth that comes through your door is probably in a 401k. Am I right with that?
No, you're absolutely right. Look, I mean, we criticize 401ks for certain things as well on this show, right? Mm-hmm. It's very rare you find in life something that's all bad and there's no good elements, or it's not suitable for anybody, right? And that's the case here. Is while you're accumulating wealth, is the 401k, and you're younger, right? Is the 401k a good option? I would say yes. So for a couple of reasons, is you are right. Most of the wealth that comes through these doors, it's people that have accumulated in their 401k. And this is the truth. Like, what he's saying is not wrong. Hey, go to the match and then do your own outside investing. Is there an argument for that? Well, you've got more investment options. You're not capped on how much you can contribute. Absolutely. Are people actually going to do it? Probably not, right? So at least with the 401k, it's you're putting 6%, 8%, whatever it is in there, and maybe if you're lucky, your company's matching another 6 or 8%, and you start that when you're 25. Well, yeah, by the time you're 60, unless you do something really dumb with that money along the way, you're going to be probably in a pretty good spot. Mm-hmm. Would that have happened under somebody's own discretion of having to do it and having the discipline to do it? I've got to tell you, probably 90 times out of 100, it's not.
Yeah, I can't see myself in my 20s or 30s,
no way.
Opening a Schwab account and picking stocks and doing that kind of thing. The idea that I just put the money in there and they took care of it and it just went into these different places.
And
that
you didn't even
me.
see it. Just it's out of your check before you get it. It's
exactly.
I don't want to say it's painless, but you don't notice it. Mm-hmm. If you've got to get that money into your account and then, well, I'm going to divide this up to my Schwab brokerage account and then go and select my investment, that's just never going to happen.
Right. Yeah. I can't see it. So let me ask this, though. The people that we're talking to here are going to be mostly in their 50s and 60s because they are the mindset. They're starting to think about retirement.
Right.
They also will come through your door sometimes with a loaded 401k. It could have $1 million. It could have $2 million or even more in there because that's where they've saved all these years. Mm-hmm. Do you have people that you walk through the door and say, okay, enough is enough? We're not putting any more in that 401k because it's a tax time bomb. Mm-hmm. So let's put money elsewhere. You have the Roth 401k option. Let's push it over there. Or your own brokerage account. Let's push it over there. Does there come a time when you say enough is enough on the 401k?
Yeah. So, well, I mean, sometimes people are forced to say enough is enough because they cap out how much they can contribute. Right. Okay. So there's a maximum to how much they can contribute anyway. Really, the answer to that is it's going to come down to what that person's tax situation is, right? So if we have a high income earner who's coming in and they're, most of the people we speak with, because you said they're, in their typically late 50s, early 60s, usually those people are in their highest earning income years when we're talking with them, all right? If your career path kind of followed that traditional path, that's probably the case, all right? Well, if we're in our peak earning years and we're going to be coming into Social Security and retirement, all that sort of stuff in a few years down the road, in most situations, your income is going to be lower in retirement than what you're making in your highest earning working years, right? So is there something we should look at where we're saying, okay, I'm in my highest earning income years, which means I'm in my highest tax bracket income years. Do I want to minimize the income I have to recognize by maxing out my 401k and then taking those distributions when I'm in retirement, potentially in a lower tax bracket? It's something that needs to be looked at, right? That may not be everybody's situation. You might have somebody that they've got so much money in their 401k that as soon as they retire, we've got to start doing some tax planning because we've got to get ahead of this thing before required minimum distributions start. And we say, hey, yeah, you've got a huge tax time bomb here. We can deal with it. We can have a strategy for it, but let's not make it worse. Let's do something else for sure.
So this is what I've done. I stopped putting money in my traditional 401k because I got the 401k Roth option. And so I have now pushed all the money into that. But then somebody said to me, what about how you treat that money? So the money that I have in the 401k, I have very conservative. The money that I have in the Roth, I have a little more aggressive because I figure that's the last money that I'm going to use. We talk about buckets of money and when you're going to use it. Does that make sense? Would you advise somebody to say, let's have different risk levels for these two buckets of money?
Yeah, I mean, the strategy you just explained makes sense, but this is what we find people use their Roth for a lot. This is not a financial planning recommendation. I'm telling you what happens in reality, okay? Because those are often two different things, okay? We'll have someone comes to us with $2 million. 1.75 is pre-tax. That's the stuff we've got to manage. We've got to figure out. We've got $250,000, the minority of it in the Roth side of it. So financial planning speaking, would you want to put that $250,000 at the very back kind of your distribution sequence and just, use the next 20 years to just grow that as much as possible? We've got this big fat tax-free bucket. That would be excellent, right?
Right.
This is what often happens is very frequently when people retire, there's something big they want to do. Hey, look, our house is 50 years old, man. We've really got to spend some money getting this thing modernized. Our retirement dream is get an RV and we want to hit all 50 states and we want to drive to Alaska, or whatever it is, round the world cruise. So the list can go on. And this thing is going to cost us a couple $100,000 to achieve, right? So do we look at taking a couple $100,000 from our taxable bucket, recognizing the income on that, which is going to boost us up into a pretty high tax bracket by the time we add Social Security and our regular distributions we need as well on top of that? Or do we look at it and we say, this is what we've always been saving in the Roth for, is so that we can access this money without affecting our taxable income. And I mean, we won't even go into this side of it, but then it blows up your Medicare premiums, all sorts of stuff, right? Or do we take it from our Roth and this was the purpose of it? Is it the most financially sound thing to do? Maybe, maybe not. We can argue that all day, but this is what we want to do. This is our retirement and this is how we're going to manage it. If that's the plan, you probably shouldn't be too aggressive with it because we're going to need it pretty soon.
Yeah, that makes total sense. There's a lot to consider. And as we sit down with Jay and talk through your retirement dreams and how they're going to be funded, this is a great way to start to look at that. So give us a call. Let's talk about you, your money. Maybe you're in that situation where you've got a lot of 401k money and you wonder, Should I keep going with this or should I go someplace else? A great part of the conversation. Give us a call. Give us a look on our website, 210-985-6200, 210-985-6200, or our website is retire210.com. And when you go there, scroll down to the bottom of the page. There's a place so you can put in a little information there. That'll give us the information we need to reach out to you and say, okay, what is it that you really want to solve? How can we help here? And then get to know each other and maybe get a date on a calendar and talk through it and do the nuts and bolts. Let's do the math on your retirement. Again, retire210.com. And remember to have this podcast delivered straight to your favorite podcast platform by hitting like, follow, or the subscribe button. Thanks again for listening to Clear Skies Retirement, and we'll see you next time.
Investment advisory services offered through investment advisory representatives at Secure Financial Management, a registered investment advisor. Exposure to ideas and financial vehicles discussed are not designed nor intended to be applicable to any person's individual circumstances. It should not be considered as investment advice, nor does it constitute a recommendation that anyone engage in or refrain from a particular course of action. Past performance is not a guarantee of future results. Investments can fluctuate, and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Secure Financial Management is licensed in your state, please contact their office. Secure Financial Management is not affiliated with nor endorsed by the Social Security Administration or any other government agency. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Wholesalers Insurance. Jamin J. Kirkwood, Texas Insurance License number 1421850.